Well, good morning, everyone, and thank you for joining us this morning for this webinar, Stress Testing Your Farm Financials. As a quick reminder, all attendees are muted and videos are shut off. However, we'd love for you to engage with our presenters today. You can do that on your computer by selecting the chat button, or if you're on your mobile device, there are three little dots on the far right side of your screen, and you can click those and then select chat. Before we begin this morning, I'd like to introduce our very own Director of Retail Credit Underwriting, Gary Book. And I'm Mike Amenzing, your Customer Education Manager. And so today, the two of us are going to talk through some of the critical aspects of farm management, and that includes stress testing your financials. And so as we all know, it's essential to prepare for some of those unforeseen challenges and fluctuations in the market. And our goal today is to help you run those stress scenarios on your farm to make sure that you're well equipped to make informed decisions on your farm during those volatile markets that we may be experiencing. As a reminder, the webinar is intended for informational purposes only and is not for public or media consumption, and any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. And so, Gary, thanks for joining us today. We're excited to get started, and I'm going to share my screen here, and we'll go ahead and kick off as soon as that loads up. So on the screen right now, we're going to see an example of the reality of agriculture right now. I'm sure this is something that is not a surprise to many of you. In fact, something you probably visit fairly frequently, right? And so right now we're on the screen, we're looking at December 2024 corn. We're looking at some of the highs that we experienced back in mid-June of 23, and then also again in October of 2023. And since then, we've seen over a 55% decrease in this market. And so this is something that we look at and we see, but oftentimes, Gary, we have a hard time making that connection to what does this actually mean back at the farm. And so the same story continues on with the soybean markets, right? We've seen over a $1.45 decrease since kind of the highs that we were experiencing in November of 2023. And so this can be one of those challenges that we look at this on the screen. We see those commodity markets fluctuate from time to time, but how often do we really step back and start to ask the question of what does this truly mean on the farm? And so what our goal, Gary and I's goal today, is to be able to share some of that insight, share what does it mean when these commodity prices are fluctuating, what does that mean for your overall financial picture, and what are the tools and tricks that we have here in America to help you make informed decisions. Well, let's take a look at what it looks like back on the farm. According to the USDA Economic Research Service that they had published just last quarter, they were projecting over a 27% decrease in comparison to 2023 net farm income. And so as we think about a 27% decrease, that's pretty critical. And so we're going to have to take that 27% decrease into account when thinking about what type of income are we truly going to be expecting off of the farm this year. And I do want to note that in comparison, this is the largest decrease that we've seen in net farm income since 2006 if this projection does hold true. So on the screen, you can kind of see that graph from 2003 to 2024 forecast or projected number that may have some challenges when it comes to thinking about what type of income your farm can produce, especially in markets that are starting to become just a little bit more volatile. And so we know that strong foundation of that is obviously crop insurance. And Gary, I'm going to turn it over to you to maybe talk about where that foundation of your market truly can come into play with the decrease that we're projecting. Gary, are you with us? Looks like we may have lost him, so I'm going to keep on rolling here. What we have on the screen right now is our spring prices for crop insurance, obviously. In 2023, we were seeing spring price guarantees at $591 in our 2024 spring price, back at $466. And then on the soybean side for 2023, $1376 and a downturn of $1155. And so what does this actually mean on the farm? Well, a 21% decrease in spring crop insurance price for corn and 16% on the soybean. So Gary, I'm just kind of talking through these percentages and what could that equate to as far as on the farm. Well, $188 an acre for corn and $94 an acre on soybeans year over year. So obviously we don't have our harvest prices yet for 2024, but when comparing apples to apples here as far as spring prices goes, that downturn is staying pretty consistent. Gary, anything else to add on this front?
Yeah, thanks, Mike. I'm sorry about that. I had a little bit of technical difficulties, but I'm back up and running. But yeah, as you can see here, most of you know that with those prices that Mike was showing earlier, I mean, this is some real stuff for you as you start thinking through your operations of this decrease in that spring crop insurance price, because that's some real money that really takes out of your risk protection. So that $188 an acre decrease for corn and $94 an acre for soybeans. That's really something to be planning for now. I mean, hopefully, as Micah said, like that, we don't have that harvest price yet, and those numbers, those guaranteed numbers, could increase, and that would be ideal. But let's take the time now while we're looking over financials and how do we plan for that in the future. And so that's really what we're trying to help you out with in this presentation going forward today.
And so you may have joined this webinar today with the question of, okay, I've heard of the term stress testing, but what Gary and I wanted to do was just level set before we kind of get too far into ratios and key metrics to watch and define it for everybody. So it's a financial analysis technique that we use to evaluate the resilience of a system, portfolio, or institution by subjecting it to various adverse conditions and scenarios. And so Gary's going to talk about here at the end of the presentation on some scenarios where you may consider stress testing on your farm through the different seasonalities that we experience in ag and how it can be a benefit to you. But I think the key point here is that it's important to play around with the numbers, right? And when we get into a volatile market, we want to see where we're going to come out on the other side before we get there, and at least have an idea of what's going on from a financial perspective. Why are we doing it? Well, it's important to be able to kind of understand in these unfavorable conditions, what can we do to be able to prevent some of that risk that may be entering the farm from a commodity price perspective, or maybe even something like weather. And so whether it be weather, whether it be commodity prices, or maybe a new purchase that you have on your mind, it's important to kind of run these scenarios through a stress test and say, what would my ratios, what would my financial picture look like on the backside of this purchase, on the backside of that selling at that price, or the backside of this risk that you may identify on the farm. And so, Gary, tell us, when we were trying to figure all this out and in a way that we could present it to our producers that really is cohesive and makes sense, you kind of boiled it down to those three ratios. Tell us a little bit about what those ratios are.
Yeah, and there's several different ratios that our producers or our farmers can look at as they're stress testing their financials, and really we don't have enough time to really talk about them all. So we're really just going to focus on three. I mean, these aren't necessarily the most important ratios you can look at, but they're obviously they're ones that I think can really help you identify if your farm may be seeing some stress in the short term. So we're going to spend some time really covering this working capital. Most of you should be familiar with that. It's a pretty basic term. It's or ratio. You see it on your balance sheet every year. We'll go through in different ways you can utilize that in making better decisions throughout the year. And then we're going to introduce something that we haven't really talked about in a long time, and that's your interest expense ratio. And how do you use that to make informed decisions? And then finally, we'll talk about the net farm income. And that's what we all look at. We all understand what that is, and it's always important to understand where we stand with that. So we'll jump right in. And really, I'll take a real quick second just to explain what working capital is. It's your current assets minus your current liabilities, and it's a very basic calculation. And really, what it's telling you is it's showing your ability to cover your short-term liabilities over the next 12 months. Or another way to think about it, it's really a measure of your short-term risk-bearing ability that your operation has. So as we think through this, what does that number say year over year? And really, as you look at your working capital on your operation, look at it over different time periods. Compare it to last year. Compare it to similar time periods so you can see how that changes over time and how it grows or how it may fluctuate. So one of the things you can do when you're stress testing, this number can vary throughout the year. If you're a row crop producer and um, a lot of your current assets is probably this time of year, it could be crops growing in the ground or even some prepaid inputs that you're ready to turn into a crop. So those things that you don't really know how that crop's going to end up by the time you sell it. So it's hard to determine what your true working capital is, like say in the spring or summer months. But also you can take a good quick look at it, see how you're doing, how that crop's doing, do maybe a rough evaluation of where you think it's going, and that allows you to really have a good understanding of your working capital. But one thing that a lot of individuals don't think through is, well, how do I use this ratio really to help you determine like maybe a future purchase coming up? Maybe you need a new piece of equipment, a tractor down the road. Do you have enough working capital to maybe put some money down, or do you have enough working capital to help maybe even cover that payment in the next 12 months? So those are things you can use as you stress test this ratio to really just have a good understanding. Do you have enough to pay all your other bills? And then on top of that, maybe do some future expansion or planning around that. So kind of similar, we'll move on to the interest expense ratio. And as I stated earlier, this is something we haven't really historically had to pay much attention to because we've had really low interest rates for several years. We and if you ever go back and you want to look at your interest expense ratio over the years, you can go and see that it's really historically ran really low, typically below that 10% range for many years. But now we're starting to see as interest rates are staying higher for kind of a prolonged period of time, we're starting to see this ratio become a little bit more relevant today. So if you look at it, it's another really simple calculation. We just take your total interest expense and you divide that by your value of farm production or your gross farm revenues, however you want to call it, and that gives you a ratio. So essentially, what that's telling you is how much of your gross revenues has to go to cover your interest costs. And this is an interesting figure because it ties into your overall fixed costs that some of you may be evaluating year over year. But this is another way to break it down to see how much is truly going towards interest. And one of the ways you can think through this is that as your interest expense continues to increase, more of your gross revenues have to go to cover that. So just as you're making a purchase, maybe potentially in the future, like we talked about earlier, how does that impact your working capital? But then also think about that total interest expense that it may be costing you on a year over year basis. And that maybe if you do have good levels of working capital, maybe you could put a little more money down, lower your overall borrowing needs, and i.e. that would decrease your interest expense. So I do like this example that we shared with you here because as you can see that historically this sample customer has ran a very low interest expense ratio year over year, about less than 5%. And then some things have happened. They had to make some purchases, had to increase their debt levels just for various reasons that was needed on the farm. And now they're running at a 14% interest expense, which is really causing maybe some concerns in the operation. But as a whole, I think they're still probably financially strong and they're all right. But now the manager needs to manage around a little bit higher of an interest rate expense.
And so, Gary, you referenced this example that we have on the screen, and I failed to mention it on that last slide. But what we did was we pulled a financial analysis summary from one of our test customers, if you will, that we've kind of put numbers into. But the reason that we're showing this to you is because you all have access to something that is exactly the same as this, right? And so as we're going through today, and if you start to say, hey, I'd love to see what my interest expense ratio is already calculated for me, or I'd like to see that last balance sheet that I completed, like to encourage you to just call into the local retail office and ask your financial officer for that latest summary. If you've done a recent balance sheet and provided tax returns, then we should have an analysis summary available for you, or can get one for you that kind of breaks each of these things down. And so, Gary, let's talk through this example a little bit further. If you had, if this was your balance sheet and you started that you just closed on a budget note, your projected interest expense ratio was up 14.32%, running a little bit higher, how would you handle this situation, or what would you do next?
Yeah, especially in this situation, as you can kind of see, this was for a budget note, and so the interest expense did increase considerably in that projected column. And one of the things I think is really important is sometimes when interest rates were low, it wasn't just front of mind to make sure you pay that debt down as soon as you got the gross revenues from the crop in. So really understanding that, hey, the longer that loan's sitting out there, the more interest I'm paying on it. So paying down the loans whenever you have the available cash to do it is really important and can limit that overall interest expense. Outside of that, really, if you look at the formula there, I mean, one of the biggest numbers of it is your gross revenues. So protecting your gross revenues, somehow finding some additional ways to make additional revenue on the farm can also help lower that expense, because the more gross revenues you have, the more interest expense you can have. So there's different ways to do this. There's different ways to plan around this, but I think one of the biggest things you can do is protect your gross revenues and try to pay down debt effectively without really taking advantage or really drawing down your working capital too low. So there is that fine take of understanding how to manage your liabilities, and then also managing your working capital and your other ratios as well. So you're not really harming either one. You're working in cohesion with them both.
Fair enough. And I think that leads us to this next piece of that net farm income piece, obviously derived from your value of farm production or gross farm income. Talk us through this ratio just a little bit and why producers should be paying attention.
Yeah, and everybody on this call is familiar with net farm income, and it's essentially just your gross revenues minus your total expenses, and that's what you got left over. And it's the profit, it's your operating profit you own the farm is another way you can put it. But it's really, this is just a basic number that kind of gives you an idea of how much money you have to pay the principal portion on your debts, to pay maybe your family living costs if there's no other outside sources of income for your household, and then also income taxes. So this net farm income's got to cover all those to some sort of degree. But this is an important ratio really for stress testing, because it's that one number that really just shows you how much your farm is generating and how much you can cover in your liabilities in the future. So we keep this in here is because it's one, I think it's a very common number to use, and it's one that you can help easily identify if you're going to have a concern in the near future.
And I'm starting to see, a margin already kind of tight there on this example of 23,000 net farm income. Kind of talk us through that very first slide that I went through was a 27% decrease. And so, what does that mean for our growers?
Yeah, and if this was my income statement and I was in this farmer's shoes, I would really step back and think, I don't have a whole lot of net farm income right there. What are some of my options to do is if my gross revenues do drop as the USDA is projecting? So I would be thinking through some different ways of, one, how do I protect my gross revenues? And then also what are maybe some potential expense categories I can start trimming down to really at least to protect my margin there, or my net farm income, because at the end of the day, if that number is negative, there's only so many options I have. So this will allow you, as your stress test in net farm income, is what are some different ways I can maybe get a little bit leaner, cut some expenses, or potentially even grow my gross revenues, or just protect my gross revenues that I've historically had.
One of the things that we'll show you here in just a little bit is a tool to be able to help do that. And a term that Gary and I like to use is kind of the aggregation of marginal gains, right? And so what 1% differences can you make on those expenses that would be beneficial for you in the long run, if you will, from trying to reduce some of those farm expenses to increase that net farm income. And so before we get to the tools portion of the presentation, I kind of wanted to talk through the key piece of this, of what is your risk. One of the things that we often like to do with our economist over at AEI, and we've presented on it numerous times, is identifying what those three risks on your farm are for 2024. And so I know many producers, if you're not in the field today, you'll be here soon as things start to dry up again and allow you to get back to planting. But while you're in the cab of that tractor, we'd like to encourage you to just think about your operation and what three risks have the potential to make a difference on your operation this spring into fall. And so those risks could look very different for a variety of different farms and likely are not all the same, but a few examples, obviously, crop failure, commodity prices. We hear about that frequently, adverse weather, equipment breakdown as we head into the fields. What are those risks on your operation? And then using those three risks, you can start to build out that risk management plan to ensure that you reduce kind of the impact that those risks have on your overall operation. But you can't really figure out what to stress test, or you can't really figure out what could make a substantial difference in your farm financials without identifying what those risks are on your operation first. The second thing that we'd really love for you to do is look at that latest balance sheet and income statement or analysis summary that you've completed to document your most recent ratios. And the reason that we want you to do that is we want you to go in and kind of highlight those three ratios that Gary just talked about: your working capital, your net income, your interest expense ratio, and highlight those so that you know where you're at today, right? You can't benchmark against something that you don't have. One of the things I often say is that you can't manage what you don't know, and you don't know what you don't track, right? And so as we often talk about with our customers, the importance of doing 1231 balance sheets and the importance of documenting this information year after year, it's so important so that we have that information to kind of benchmark against so that we can start to run these scenarios and see what potential purchases could do to your overall operation. And so we've talked a little bit about what those pieces of the puzzle are that we can kind of run through and run scenarios, but we haven't really talked a whole lot about the how that you have available to you. And so I want to highlight really two different tools that we have at Farm Credit Mid-America that's available to our customers. The first one on the screen here is the Farm Credit Mid-America Credit Factors tool, where customers can kind of follow along on their balance sheet, enter in their assets, their liabilities, and their farm income, and then go in and do projected different purchases. So purchase 1, 2, and 3 at the bottom of the left-hand side of your screen. You can put in a projected purchase that you're thinking about, and on the right-hand side of the screen, it will spit out what those ratios would be as a result of that purchase. You can see your actual versus projected, which is a really great tool to be able to help make your decisions when thinking about some capital purchases potentially. Now, you may be wondering, Micah, more so on the variable costs, right, that we're talking just a little bit about. And so we have a different tool for that, which is our monthly cash flow and break-even analysis tool that's available to you, where your customers can go in and enter their equipment or term loans, their projected income on a variety of different commodities that they may be having and selling, and then obviously the expenses as well based on commodity. What that is going to do is it is going to spit out some variable ratios and some fixed ratios that, Gary, maybe you can kind of talk us through just a little bit more on this slide here.
Yeah, so one of the good things about this tool, if you take the time to fill it out, and I will put the disclaimer out there, it is a lot, but the more you put in it, the more you can get out of it too. So, but the good thing about this tool is that once you get it all entered in, it calculates all these ratios for you. And as you can look here, there's those adjustment columns kind of in the middle. And as you're starting to think through and you're making plans or you're stress testing your operation over the course of the year, you can make adjustments though. If let's just say at that top left corner, value farm production there, if maybe you think your crop's doing a little bit better than you initially had planned over the initially planned. Maybe you think you're going to have some higher gross revenues for the year. You can make that adjustment and see how that impacts your overall costs and your different ratios. Um, but on the same thing, maybe you're having a little bit of struggle. Weather's not cooperating with you, and maybe gross revenues are going to come in a little bit lower than they did the previous year. You can do the same and then plan accordingly about that. It'll allow you to have better knowledge of how your overall expenses to your gross revenues are going to look. Um, but maybe you kind of identify weaknesses early on and you cut a lot of costs and costs are coming in a little bit lower in certain categories. You can do the same thing on the variable cost section right there. So this tool just allows you to really kind of plan ahead and to think through different scenarios you may have on your operation, and then then help maybe even forecast out a little bit more uh, to where you think maybe you'll end up at the end of the year, and then help plan for any additional purchases. So it's a tool really for you. There's a lot of different things in it. There's more to that than just these screenshots we provided you, and feel free to reach out to your loan officer, and they can provide it to you for really your use.
So you may be sitting there thinking right now, wow, that Excel sheets have never kind of been my forte. That's why I'm not a credit officer, right, Gary? And instead I like to be in the cab of the combine. And that's perfectly okay. And so we wanted to be able to kind of talk through, if you're not interested in the Excel methods to be able to do it, are there still ways for you to kind of stress test your farm on the old paper and pencil? And the answer is absolutely yes. The ratios that we selected when kind of talking through how to stress test and see what it would do to your overall financial picture were somewhat easy to calculate on paper and pencil. And so how do you actually go about doing that? Well, first and foremost, you've got to gather that financial information. Your income and your expenses are a great place to start, and then your assets and liabilities. Our hope is that we have an updated balance sheet and income statement from you here at Farm Credit, and that you can call in and we can provide that to you so that you have kind of that starting base. If you're not somebody that has submitted yearly financials or updated a balance sheet every year and would like to start doing that, it's never too late to start, and we would always encourage that. So call into your local retail office and start to get that set up for you. Where you can just quickly call in at the end of the year, kind of run through, update your numbers from the previous year, and feel like you have really good, accurate financial information to help you make informed decisions. The second thing that you're going to do after you've gathered that information is kind of identify what those risks are on your operation. What stress scenarios may you experience, and what would the financial impact of that scenario be? And then third, we're going to go in and we're going to start to calculate what it was before and calculate what it would be after that scenario. And what does this mean for my farm, whether it be from a working capital perspective, whether it be from a net farm income, or a potential purchase, and what could that look like for my interest expense ratio? And so once we have that comparison, we're able to start to make informed decisions, and we're able to kind of start to talk through of what does this mean for my farm, and is this a good move for me at this time? So Gary, kind of tell us about the different scenarios, if you will, as to when some producers may consider using these tactics.
Yeah, and I think any farm, they have different types of risks throughout the year. So I don't think there's any kind of one way to really do this, and it's not really a one-stop shop. I think is anytime as you're going through your operating cycle on your farm, is to really think through what are the key risks right now. Maybe I should take out some of my financial statements and start looking through, hey, how has things changed since the last time I looked at these numbers? So as we think through, I mean, Mike has provided us four really good opportunities or different things that we may need to analyze our risk and do some stress testing on our financials to see how well those are panning out in our planning. But I mean, as we think of where we're at today, I mean, probably crop input selection and your equipment purchases, they're already for the most part completed for the year. So those are times now where we can kind of sit back, see where we're standing after those decisions we've made, and really kind of start to think forward. Okay, so if I hit a trend line yield, where would I be based off of my current numbers? If that 40 acres down the road pops up for sale? Am I going to have enough working capital, and do I have my fixed cost in order um, to make that purchase potentially? What can I do to get ready for that? And then really, I think something throughout the course of the year you really could be working on is really your marketing plan, because that evolves constantly. It evolves with how your crop's maturing, and how well the crop looks in the ground, of projecting out that projected yield. Where are you going to land? And then really, obviously, as everybody in this call knows, is that the markets change daily, and things could really impact that throughout the course of the growing season. So always stepping back, looking at your crop, where that is, where your marketing plan, where your break-even prices are, that's really stress testing your financials as well. So if prices start running up really well, how does that impact your break-even price? Or if prices continue to fall, what can you do to where you're being more proactive about your marketing decisions versus reactive to what's happening in the market? So there's some scenarios there that you can run through of what, based off of where you're at today, what do you think your bushels times your acres times the projected, or what you think you're going to get for your commodity, and project your farm income out. You should have most of your expenses more or less locked in, and then really kind of figure out where your net farm income's going from there. That allows you a good starting point to understand what maybe you need to market your crop throughout the course of the year to generate a net farm income that you really need for your operation to succeed. And then kind of in the second scenario where we're kind of stress testing a purchase, and understanding where your expenses are, what you think your projected net farm income is going to be. Does that new purchase really fit in there? And then at the end of the day, you got to make that call, because sometimes, yeah, I mean, you have a key tractor breakdown, you're going to need to buy that. That's kind of critical to your operation. So, but understanding how that impacts your operation is also important for you to make better management decisions throughout the rest of the year.
Next, we kind of want to go into what questions. We've covered a lot here in the past 32 minutes, and so we want to kind of ask or answer any questions that you all may have. I've got a few that has come in during registration that I'm going to start with, but if you would like to ask a question, feel free to do that via the chat feature, and we will make sure that gets answered. The first one, Gary, that I kind of want to talk through is, what are some options we have to rebuild working capital if it is starting to deteriorate?
Yeah, and that's a great question. And I think the key question you should always ask yourself if you've noticed a deterioration in working capital is, what caused it? If you don't understand what's causing that deterioration, you can't really fix it. Sometimes it's pretty obvious. Maybe you made a large purchase and you put a large down payment. Well, that's going to drop your working capital, and that's perfectly fine. You know what caused that. And now you got to change your focus to rebuilding working capital. But some of the key things you can do, one that's kind of easier said than done, is really increase your net income, because as your net income increases, you can retain more earnings to the top side of your balance sheet, and that would increase working capital over time. But being realistic, that isn't always the easiest things. But maybe you got to find another source of revenue to generate more net income. So think through different ways like that. If it's really tight and you're really concerned about it, there's some things. Go look around your farm. Is there some assets that you're not really fully utilizing? That's another way you can do that. You can look at maybe selling non-critical assets that you don't fully utilize on your farm, selling that, either paying down some debt or even retaining it on cash on top side of your balance sheet could easily replenish working capital in times of need. But I think at the end of the day, you can do any of those measures, but if you're not truly understanding what's causing that working capital burn, either it be high fixed costs or low profit margins, or or just a lot of down payments on capital assets, if you don't make those operational changes, you're just going to continue to be back in that situation a couple of years from now. So think through what's causing those changes or causing that working capital burn, fix that, and then try to find the solutions to rebuild your working capital over time.
Gary, one of the questions that just came in, I think, is kind of interesting. It talks about what take all the USDA data out of it. What is Farm Credit Mid America kind of seeing from their territory, or what are some things that you've seen come across your desk, kind of trends?
Yeah, just kind of at a high level. And it's nowhere in particular. It's really across their entire association. But we are still seeing really strong financials from our customers, and we are seeing some declines in working capital. And I think that was kind of expected as based off of just what we knew what happened in 23 and first part of 24. We've seen some slight declines in working capital across most of our customers, not all of them. But all in all, so many of our customers out there have done such a great job of building their balance sheets and building equity and working capital that we're still seeing some really strong financial ratios. So as a whole, I do feel like the farm economy is in good shape. So.
Somebody just asked, where can I get the tools that you all had showed from an Excel perspective? That is something that we would love for you to kind of call into your local office to receive. We do not have them posted on our external website just because we want to make sure that when you are downloading and using that file that you have the best information to use it correctly. And so we'd love for you to call into your local retail office to gather that Excel sheet and start to plug and play some of those numbers, but we'd be happy to provide it to any customers on the call. I think I've got one last question here for you. And how would you balance paying off the debt to reduce interest, but also the working capital? I think that's a balance that a lot of customers are trying to feel right now is, do I make more of a down payment to be able to reduce that interest expense and burn through working capital, or is working capital the priority? Do you have a thought on that, Gary?
It, there's no real silver bullet to it, and I think my best piece of advice for that is set some sort of benchmark of where you feel comfortable with your working capital at. Our standard for working capital to your gross revenues is 20%. I know there's some ag economists that says a really healthy level of working capital to your gross revenues is roughly 30%. So if you set your benchmark for your farming operation at 30%, once you get up to that 35-40% of working capital to your gross revenues, yeah, feel free to draw down that excess working capital to pay down debt to lower your overall interest expense. My biggest piece of advice is just don't run yourself too thin. Working capital is it's that short-term risk bearing ability you have on your operation, and if you get that too tight for you, you're going to feel it. And there's a saying we have in credit sometimes is really your working capital and your liquidity is that buffer you have between your lender. And what I mean by that is the more working capital you have, the more say you have in your day-to-day operations and your management decisions. The thinner you get on working capital and liquidity, the more say that your lender or your operating lender has on it because you're having to use more borrowed money to operate day to day. And so just make sure that you're really being cautious and holding sums of working capital that's going to protect your operation in the short term, and that it's going to allow you to mitigate any short-term risks that you may have over the next 12 months.
So as we close out, we want to just kind of break it down into three key pieces of everything that we've covered, Gary. So can you run us through those? What are the three key takeaways that if you were a producer listening to this call that you'd want to walk away with?
Yeah, so we touched on it. The margins are trending thinner. And so really just try to be very considerate of both your fixed and your variable costs. So fixed costs are just your payments and your cash rent and all that. Your variables, your operating expenses. So really paying attention to those, making sure that you're cutting out unnecessary expenses so you can really try to keep that margin as wide as you possibly can. Gross revenues are potentially could be lower than what they were in previous years. So we really want to make sure that producers are really focusing on how can they keep their margins as wide as possible. Really, the best way to do it in our eyes is to continue to monitor your key ratios. So we gave you three of them. today: working capital, interest expense ratio, and net farm income. But there's several others. There's many others that you can look at to really help you make good management decisions. But understand where you're at. Make sure you have good, sound, accurate financial statements so your ratios are accurate. That's very important as margins tend to decrease. So with that, utilize all this. So the stress testing we talked about, your good, sound financial statements, and then create a really good risk management plan to really help you understand where you're at in your operation. How do you mitigate any risks that you've identified that Micah asked you to think through? And then what do you do put into place to really protect yourself in case some of those do come into play? So just think through that, and knowledge is really the power for you to make the right decisions, and having that information in front of you ahead of time can make you be a lot more flexible when those things do arise.
And as we close out, I just want to reemphasize something that Gary had said, and that's that we don't want you to make these decisions or feel like you've got to go at this alone, right? Part of the reason that we hope that you do business with Farm Credit Mid-America is because we want to be a part of your team, right? We want to be a resource to you. And so as we've kind of went through and talked about the different tools that we have or the different ratios that we monitor, we hope that you'll call your local financial officer or account specialist to start to talk through some of these things that may be impacting your farm so that we can help and support our customers. And that's part of the value proposition that we hope that you find valuable to you in your operation. And so with that, thank you all so much for joining us today. This is going to be recorded and sent out to all attendees that registered following the webinar. And so we do appreciate it. And we look forward to seeing you on our next webinar. Thanks, Gary, for all your insight, and we'll see you all next time.
Thank you, everyone.